So in these three people are the only three people in the world, and they live in this imaginary world. There's Jim, George, and Fred. And there's only one bank in this world. Here's the world. And these people can only go to that one bank. And everything in this video that I explain is the same as if it applies to a whole bunch of banks and a whole bunch of people. The same will apply to what I'm showing in this video. This video is about fractional reserve banking, and it also explains how banks create credit. Alright, these three guys are all bakers. They bake bread. So they all bake bread and they earn $1 each for selling the bread. So all three of these guys decide that they don't want to hold on to their money out of the bank. So they go to the bank and they deposit the money in the bank. Jim, George, and Fred. So the bank has $3. Now George thinks to himself, I think I have an idea of how to make a bunch of money. I want to buy a bunch of flour and make a whole bunch of bread. So he thinks, but I don't have enough money to buy all the flour. So he goes to the bank and he borrows $2. So he takes the $2 and he doesn't know where to buy the flour. So he thinks, oh, Fred has a whole bunch of flour. So he takes his $2 over to Fred and he buys a bunch of flour from Fred and takes it back and starts making bread. In the meantime, Fred decides that he wants to keep his money secure, so he puts the $2 back in the bank. So George makes the bread and he earns another $2 for making and selling the bread. So now he owed the bank the $2 that he borrowed for the flour. So he decides he's going to put the $2 that he earned into the bank as well. Now the bank is looking as though it's very rich. It has $5. By making only one loan, it has $5. Originally there was only $3. Now Jim hears about George's success and he wants to do the same thing, but he's going to do it even better than George. So he borrows $4 from the bank. Now here's the concept of fractional reserve banking. The bank only has $1 in the bank and they have loaned out $4. So if Jim, George, or Fred, if Jim, George, and Fred decide to go back and get their $1 that they deposited long ago in the bank, there's only $1 in the bank. So Fred could get his dollar out, but George couldn't and Jim couldn't. So the bank would be in trouble, and that's the defect with fractional reserve banking, is if too many people try to take out their money, the money's not there. Now, Jim goes back to Fred just like George did, and he buys the flour from Fred. Now Fred decides once again that he's going to keep his money in the bank, so he puts his $4 in the bank. And now Jim, because he's been so smart and making all that bread, he makes $1, $2, $3, $4, $5 for selling bread. Now he takes the $5 and he returns his loan of $4. There's his loan of $4, and he earned an extra $1 because he's a little smarter than George, and he earned a bit more bread. So consequently he puts that in. Now you can see the bank is very, very rich, and it appears to have a whole bunch of money. Now you can see that the bank has the potential of loaning huge amounts of money, and maybe only keeping this $1. They could loan out all this money to somebody and just keep one in reserve. So this is how the bank creates credit. It creates credit by having not only the loan money that these people borrow from the bank, but they have all of their assets, all of their money that they've earned. It also goes in the bank. So the bank appears to have a huge amount of credit that it can loan out to people. And you can also see that the bank apparently has a lot of money. Of course, it's not the bank's money. It belongs to the people who earned the money and deposited the money. But the bank appears to have that much money. So this is how banks create credit, and that is how fractional reserve banking works. I hope this has helped explain the situation a little better than some people have in their mind. Good day.